Warm good evening to all the participants. Asset allocation is an investment strategy that tries to stabilize return over long periods of time, tackling the volatility. Traditional thinking of asset allocation has dramatically changed in a world which has become a global village. Both in equity and debt, along with new avenues like REITs, currency, and commodities, have opened a global door for Indian investors, which can be secular, tactical, or business cycle based to reduce the concentration risk in a portfolio. Today, we have Mr. Mihir, who is a fund manager global PMS with PhillipCapital, who is going to present two unique strategies from global investing. Mr. Mihir is an IIM graduate from Ahmedabad, and he is a chartered accountant with over 6 years of experience. Earlier, he worked for DSP Asset Management Company. I hand over the stage to Mr. Mihir, and he will make the presentation for first 35-40 minutes. After that, we will have a Q&A. Thanks.
Very good evening, all of you. And thank you so much, PMS Bazaar, for giving us the opportunity to present our global PMS strategies. So we are domiciled as Phillip Ventures IFSC Private Limited. We are a part of the PhillipCapital group, and this entity is based out of Gift City. So, I begin the presentation with a very crucial question. So first is about PhillipCapital. So PhillipCapital, as all of you must be aware, is a large financial services firm. And this firm is headquartered in Singapore, but we have presence in 15 countries. And as a group, we offer more than 40,000 different products, and we manage a total AUM of $47 billion US. Across the globe, we are happily serving 1.3 million clients worldwide. And our services include fund management, broking, research, and other services across various asset classes. In India also, we have a very strong presence. And what I would like to highlight is that we have a very successful portfolio management services arm in India, which has a very good track record of delivering performance over a period of time. In fact, I also take the opportunity to share with you that last year, our multi-cap portfolio actually won one of the best performing funds as per CRISIL in the multi-cap category. So this really speaks about the efficiency and the thorough research with which our portfolio management services are being provided. So with this, I begin my presentation. And I begin my presentation by answering a very crucial question, is that why should one consider international allocations in the first place? I mean, today there is so much information available about global investment products. There is a lot of curiosity among investors, and many of us are actually investing even in overseas markets. So for all of us who are considering global investments, or all of us who are just curious to know about it, that why should we go out and let's say invest in areas outside India? So there is one data set that I would like to present, which is very, very self-explanatory. So what all of you see in front of you is the country-specific benchmark returns of some of the largest indices. We have Japan, Korea, we have a couple of indices from China, there is Hong Kong. The blue region is Nifty 50. And of course, we have UK and of course, the three major indices in the United States. And of course, if you look at the blue shaded region, which is Nifty 50, you will wonder that in the previous decade, Nifty has not been the outperformer overall. I mean, yes, there were a few years in which the Nifty did do better than other benchmarks. But overall, I mean, this data is for the previous decade, the 2010 to 2020, and then of course, 2021 too. So 12 years of data, and I have also presented CAGR at the end. What we can see that the major chunk of returns has actually come from the US markets. And I mean, if we really have to deep dive into this data, so I would also highlight your attention, particularly to the latter half of the previous decade, that is 2016 to 2020. So what we can see that indices like NASDAQ have actually delivered phenomenal returns in the second half of the year. So question is, what are the insights that we can really draw from this data set? Okay, so this is where we come to the next slide. So as I mentioned that US indices outperformed other indices. And the insight that we can draw is that in the previous decade, the industry 4.0 considerations started taking hold, okay, into businesses across the globe. And a clear insight is that markets in the previous decade, particularly the second half, have actually rewarded those countries, those sectors, and those companies which are very high on technology disruptions and innovations. And as all of us know that the major technology giants, major healthcare giants sit in United States. So returns were actually flowing over there. I know that right now may not be a right time to talk about US indices because on a YTD basis, the NASDAQ has corrected, the Dow Jones has corrected. And of course, there is turmoil on the global markets. But what one really needs to see is a longer picture, okay, picture for this current decade and many, many decades to come, how disruptions and transformations have happened across businesses. So coming to the second point, that there are some select countries that actually stand to gain from emerging trends. So global investing is not just about investing in, let's say, United States or only China, but there are so many other countries. In fact, if you look at the universe of ETFs alone, there are more than 55 to 60 different countries in which you can take exposure to using ETFs. I mean, who would have imagined that with the entire electric vehicles revolution coming up, okay, lithium batteries is in demand. And a country in South America, Chile, is actually sitting on the largest reserves of lithium. Or, there is a push towards nuclear energy, and Kazakhstan is actually suddenly in the news, okay, because of the nuclear reserves. So we are really talking about those opportunities outside India, which otherwise you will not have access to if you are considering only Indian equities. I mean, yes, there is a very strong reason. In fact, if I just have to share an insight, the latest IMF forecast which came has actually pegged India as the fastest growing economy right now. Okay, the GDP is expected to grow somewhere around 8%. So surely, I mean, yes, we are definitely bullish on India. But what we also have to consider is there are so many new emerging trends which otherwise you will not have access to if you are looking at only India. So that is other reason to diversify. It is not just about dollar diversification. It is actually tapping some of these untapped opportunities which are actually available to investors in the form of listed instruments. Okay, coming to the next point, the post-pandemic business landscape. Now, all of us know that the pandemic has been a very tough time for us with so many lockdowns across the globe. I mean, with China resuming lockdowns with endless waves. But what this pandemic has also done for some of the businesses is that they have permanently disrupted the way some of these businesses operate. Okay, work from home is no longer a pandemic-induced requirement, but some organizations have really gotten back to the entire work from home. They are exploring this model whether or not there is pandemic. In fact, a report by a major consulting firm also said that because of the pandemic, a lot of digital transformation, which was planned for something like 25 or 26, like 2025 or 2026, a lot of major organizations have actually preponed the digital disruption. So, right now we are looking at a post-pandemic world. Okay, yes, I mean, there are pockets of regions where, the COVID-19 virus still continues to wreak havoc. There is supply chain disruptions. Okay, there are geopolitical tensions. But as we speak, some of these businesses, particularly around technology, have been disrupted forever. I mean, that is a positive kind of a change, which the pandemic has actually brought about. So yes, we are talking about innovations, and I have presented, some specific innovations across different sectors. So for example, technology. I mean, today it is, the reality is that today technology is not a standalone sector. You have elements of technology across different industries. But even in technology, so there is artificial intelligence, there is robotics, there is Internet of Things. So nobody can visualize investing in these themes directly if you are only considering Indian equities. Even in healthcare, there is genomic revolution, neurotechnology, medical devices, financial services. Okay, traditional financial services is at a brink of disruption with decentralized finance coming in. A lot of experts have started voicing out that traditional banking industry is up for a very big disruption in the years to come. Similarly, manufacturing, 3D printing. I mean, who would have imagined that in order to counter the supply chain disruptions, today, instead of sourcing parts from different countries, there are industries that actually can print some of these parts in-house using 3D printing. You have all sorts of things that can be printed, from meat, from vegetables to houses. There are 3D printed products available. And of course, climate change. I mean, with every passing year, the concerns as well as the effect of climate change are being widely felt. And even organizations and nations have sprung into action. Okay, so there is a push for electric vehicles, there is a push for renewable energy, there is a push for nuclear energy. Okay, assuming that the safety standards are met. So if I have to really summarize all these points, so that is exactly the reality that we are in right now. That today traditional businesses are a thing of the past. The new themes, the new disruptions are traditional businesses today, and the pace of technology is only expected to deepen further as we move into the decade. And of course, there are investment opportunities which allow investors directly to gain access to such exposures in listed securities. One need not go at a startup. I mean, if somebody, for example, wants to go in for a cybersecurity, one need not hunt for cybersecurity startups. Okay, you can directly have exposure to cybersecurity companies in the United States, for example. So, I mean, those are the kind of avenues which are available to the Indian investor. So with this, we introduce the Phillip International Portfolio Solutions. As Sir mentioned, that we have a couple of strategies under the international portfolios. And as we speak, the funds are already live. So we have already started investing for our first set of clients in Gift City, something that I will touch upon in the latter part of the slide. So our first portfolio is the Phillip International Pioneer Portfolio. Now, this is an equity portfolio, and the focus of this portfolio is investing in various sectors, themes, and geographies, which we believe are poised to grow over the medium to long term. The emphasis for this portfolio is on innovations and regional developments that result in potential upside. So what we are really looking at, we've mentioned in the second point, that we are looking at investing in the trends of today, but also the ideas of tomorrow. So today, at our end, of course, there are sector classifications available, but there are a lot of thematic classifications that we at PhillipCapital have developed in-house. So there are more than 60 plus different themes that we are tracking on any given day. And these themes range from a wide series of avenues, right from semiconductors, artificial intelligence, to water sustainability, nuclear energy, as I mentioned. Okay, some of these commodity miners or commodity producing companies. And then there are also some other themes like pet care or even work from home. I mean, who would have imagined that there are actually instruments available only around the work from home concept? But yes, those are the investment products available, and those are the themes that we are tracking. So in this portfolio, primary allocation is to equity, but we also have the flexibility to allocate assets even to the newer and emerging asset classes. So what we mean by newer and emerging asset classes is that we are looking at cryptocurrencies, we are looking at bitcoins, we are looking at carbon credits, or even SPACs for that matter. So, if the risk reward ratio for such investments is favorable, so that is where we may look at some of these assets also. But right now, primarily it is an equity portfolio. Now, as I told you, as we speak, this fund is already live. Okay, it is live since January. So for the first 3 months, we've been able to invest, allocate clients securities. But in order to establish a very robust portfolio process, we have done a very, very comprehensive back testing of our strategies. So what you see in front of you is returns for a 6-year period of back testing, which is from 2016 to 2021. And what you can see is that this is the CAGR which the back tested results have shown. It is very, very promising. But a very important point, okay, and of course, we've compared it with the benchmark also. But a very important point is that these are dollar returns. So the rupee depreciation that has happened over these past 5-7 years, so that is something that is not even factored into these returns. If you were to add, let's say, 2 to 3% rupee depreciation per annum, the portfolio returns actually will go upwards of 18 to 19% on a 6-year CAGR basis. So, that is the benefit of dollar diversification that we are talking about. The next portfolio is the Phillip International Universal Portfolio. Now, this is a multi-asset portfolio where we are focusing on multiple asset classes, geographies, and sectors, where the emphasis is on diversifying capital across various asset classes and across instruments with different risk characteristics. So, primary allocation to this portfolio is equity and fixed income, but we are also looking at other asset classes like REITs, commodities, currencies, depending upon our view on the asset class and the expected return. So similar to the previous portfolio, even for this portfolio, we have done a very, very detailed back testing. And these are the dollar returns that we have presented over here. And of course, both the returns that I presented, the previous portfolio as well as the current one, these returns have been arrived at after deducting our fund management expenses. So, after deducting, these are like the net returns and dollar denominated returns. So you convert it to INR, the returns would be more, but we'll keep it to dollar returns. So, our portfolio management process in a nutshell. So what we are offering in the Gift City, like through the Gift City route, is dollar denominated portfolio. We are investing only in US listed securities, and the very important reason for us to look at only US listed securities is that because US is the largest market, the volume of securities is more. And if we want exposure to other regions also, like if we want to look at a China-based ETF, for example, or let's say a Taiwan-based ETF, we can directly buy it in US. The advantage for us is that all these securities are dollar denominated. And even in Gift City, the funds are dollar denominated. So for us, it is like, everything is in US dollar terms. So to that extent, there is no currency risk that we assume at our end. Okay. And of course, this is global investing through the Gift City route. Okay. So while the infrastructure in Gift City is evolving, but the operational setup is in place, which, brings me to the next point, the pillars of our process. So our funds are offered with a very, very long-term focus. So what we mean by that is that we are not frequently churning our portfolio. Okay, we are really investing in securities where we believe that we have opportunity to make a considerable upside over the medium to long term. So we are not frequently trading in the portfolio because it will only unnecessarily add to the trading costs. Next is that we are following a research-driven approach. So, as I introduced PhillipCapital Group to you, so we have a global presence, and that really, as a global fund manager, it really gives me the opportunity to interact with multiple teams across the globe. Okay. So what is actually being offered to our investors is a culmination of all these insights. And last and perhaps the very important point is seamless execution. And why am I calling it an important point? Because this is something that we have demonstrated in our Gift City dollar denominated portfolios. So, setting up accounts, receiving funds or transferring funds to Gift City, and then from there allocating into global securities has been a very, very seamless experience for us. See, the basic part about this product is that at the end of the day, it is a PMS product. So the operational experience for the investor, okay, in terms of depositing funds, receiving, all the account statements and everything is exactly the same like a PMS. So there is absolutely no complexity over there. What the only value addition or the value proposition is that the investment universe is that of global securities. But otherwise, operationally, it is a PMS. So, I mean, it is not something which is very, very new or very, very discomforting to the investor. And of course, the last point I would like to touch upon the Gift City. So just last week, the IFSCA fund management regulations were published. So before that, like in addition to these, we also have the IFSCA capital market intermediaries. So as all of you may or may not know, that Gift City is operated or regulated by IFSCA, which enjoys its status as a unified regulator. So when we call IFSC a unified regulator, it is governing all the businesses within Gift City, be it banking, be it insurance, be it fund management, investment advisory. So there is no SEBI jurisdiction over here as we speak. I mean, there was a time where we are taking guidance from the operating guidelines of SEBI, but now IFSCA has its own set of regulations. And the vision of the government of India is actually to make Gift City at par with some of the international financial services centers across the globe. So, centers in Singapore, Dubai. So So in Gift City, I mean, the regulators are very, very proactive, and it is the vision of the regulators to actually adopt the best practices, regulatory as well as operational practices, so that India can actually scale up the financial service center. And then, of course, the last point, the LRS route, which is available to the resident Indian investors. So, for all foreign exchange control purposes, Gift City is actually considered to be an overseas jurisdiction. So, for resident Indians investing in the Gift City to a PMS or any product which is based out of Gift City, the investment route available is LRS. So, using the LRS route and submitting a Form A2 with their respective banks, investors can remit US dollars to us, as in Gift City, and that is where the investments will happen. So now I take the opportunity to share something about our portfolio management team. So I am Mihir Shirgaonkar. I am the fund manager for the funds. I have presented my professional background as well. So I come with a 7+ years in the mutual fund industry, 7+ years of experience. In my previous role, I was with DSP Mutual Fund, which was earlier DSP BlackRock Mutual Fund, where I worked for the ETFs and Passive Investments division. And of course, I have presented my academic background as well. Now I have my own team in Gift City. Okay, so we've got a dedicated compliance function, a dedicated dealer function. We are looking at increasing our research force as well. Now, this is an addition to a very strong team of institutional research analysts that set out of PhillipCapital India. And those research analysts are sector experts. They come with an average experience of 10+ years. And they are ranked anywhere between number 3 to number 1 in their respective sectors. And of course, there are these global teams of PhillipCapital as well, as I mentioned to you. So as a global fund manager, I have the opportunities to interact with multiple teams. As I mentioned, that we have a presence in 15 countries. And now, most important point, the investment committee. So there is an investment committee which sits above me, and every investment recommendation which my team is making and which we propose into the portfolio is thoroughly vetted by the investment committee. This committee comprises of the top management of our firm, our head of compliance, who are thoroughly evaluating. I mean, the very reason I'm mentioning about this investment committee is to assure all of you about the kind of involvement and the kind of seriousness with which we operate the global PMS. So that was about the global PMS, the portfolio management team. And with this, I also come to the end of the presentation. So if you do have any questions for us, so we've presented our Gift City email ID also. It is ifscglobalpms@phillipventuresifsc.in. So any questions, you can drop us an email and we will be more than happy to answer them.
Some questions have
Sure.
So, when India is the first question I'm reading out, when India is a secular growth story, how asset allocation to multiple countries help?
Sure, absolutely. So, as I had mentioned in the presentation, that yes, we are very, very bullish on India. I mean, just I'll reiterate the recent IMF forecast, which actually puts India as having the highest GDP growth right now. But still, there are some pockets of opportunities, okay, particularly around disruptions and emerging trends, which you will otherwise not have access to if you are investing only in India. So here the question for the portfolio, for the investor, is not about investing in India or investing in global securities. It is all about investing in India and investing and having some decent exposure to the global markets. Okay, so that is where. So yes, when we are talking about the global trends and global themes, we are absolutely not disregarding the India growth story. That is something which any which ways is there. But it is all about diversifying the portfolio and the benefits of dollar diversification that can potentially add to more returns to the portfolio. So yeah.
The second question is, how asset allocation to multiple countries investing mitigates the concentration of investing in a single country?
Sure. I think that this is a very, very relevant question given the recent turmoil in the capital markets as well as the recent volatility. So I think a couple of examples can come to our mind. First is that of Russia. So, of all the geopolitical tensions because of the Russia-Ukraine conflict, there have been a lot of sanctions imposed on Russia. A lot of Russia-focused ETFs in United States have corrected by more than 80%. Okay, and some of the ETFs have even stopped trading. So there is one ETF that we were tracking that has actually stopped trading from 3rd or 8th of March. Okay, so that's number one. Second example is China. So very recently, okay, this the US came up with this holding public companies accountable act. Okay, there, all the Chinese firms who are listed, who have their securities listed in the US exchanges, are required to comply with a lot of, information and regulatory requirements. And very recently, under that act, US has actually ordered 5 Chinese companies. Okay, and it has indicated that these 5 major companies can actually suffer a delisting in 2024 if they are not complying. I mean, yes, I'm going slightly into a detail here, but question is that, once this news was out, okay, there was turmoil across the Chinese markets. So there is one Chinese ETF, okay, that was down by more than 25% in a single day. And like 30 to 40% correction very easily happened in China and Hong Kong. So, that is where, looking at, so this is why the mitigation of single country exposure risk becomes all the more relevant. Like people may have a bet on emerging market economies and they would like to, let's say, concentrate their portfolios in, select countries. But when, specific events like these happen, a global diversified portfolio. Third example is, of course, the Nasdaq itself. I mean, right now as we speak, the Nasdaq is down more than 20% from its all-time high. So only, when you are diversifying across different regions is where you can mitigate the single country exposure risk.
India is the most resilient market now. Generally, Indians want to keep the money closer to home. What kind of profile should go for this global investing? What is your input?
So, of course, I mean, global investing is, just like it is actually equity or other asset classes of different countries. So, of course, if people have a very stable portfolio in India, so of course, we don't recommend that, they should liquidate the entire portfolio and just go all in into the global securities. So anyone who is sitting on surplus capital, okay, so such a person, or anyone who is who's sitting on an existing portfolio, but considering fresh investments can consider global securities. Third category is, what we could call savvy investors, like people who are actively tracking some of these global trends, like people who come from those industries and who understand these industries better. Like very simply put, a medical professional in India could very well understand the entire healthcare space happening globally, right from digital wellness to medical devices to genomic revolution. So if such a person has a good understanding of, how that is functioning, so that person can look at some of these, sector specific ETFs. And obviously there is the fund management solution that we are offering where our expertise comes into play. And that is where, we invest across different themes and regions.
The next question is seeking alpha or to reduce risk. Which should be the most important priority when someone goes global for investing?
So both of them are important, of course, seeking alpha and reducing risk. But even with between these two, we would, I would personally feel that reducing risk is very, very important. That's number one. And then, one can go in for generating alpha. The very reason why I say this is that if we have a look at the developed markets, so a lot of stock-based strategies have actually been underperforming the benchmarks. Okay, and this is evident by way of the SPIVA report, which comes out on a half-yearly basis. So if one has to really look at the tables of the SPIVA report, one will find that roughly 80 to 90% of the active fund managers have actually not been able to outperform indices over a longer period. So generating alpha any which ways has become quite difficult in developed markets. India, still remains a land of alpha. So, given this framework and, given this reality, and because we are looking at investing also in some of these developed markets, I think the first priority should be reduction of risk. And then depending upon some of these opportunities, some of these emerging trends, some of these themes, which the benchmarks may be underweight on. But if you have that kind of conviction, you can go ahead and attempt to make an alpha.
The backtrack performance says Pioneer has done better than Universal. If a customer has got limited capital to put in into only one PMS, how to distinguish and how to decide between Pioneer and Universal?
So, I mean, for this, the risk profile for both the products is different. The asset classes for both the products are different. So, this is, I mean, we really cannot decide whether one should go in for a Pioneer or a Universal portfolio, like right here, right now. A thorough profiling of the investor is necessary. So whenever investors come to us, we do a detailed risk assessment, a thorough profiling of the investor, a due regards. Okay, in fact, the first priority is looking at investor objectives, and then accordingly making that decision whether one should go in for a Pioneer or a Universal.
On what parameter PhillipCapital takes exposure for different countries in a portfolio?
So at our end, we are monitoring some of these geopolitical developments. Right now, we are actively monitoring the policy action of the central banks across the globe. Okay, so be it United States, be it the Eurozone, or be it Japan. Okay, right now, as we see that the Japanese currency is depreciating. So we are monitoring some of these policy actions. We are looking at some of these economic indicators like the GDP data, and then making an assessment of how the future could be. Of course, supply chain disruptions, high input costs is something which have really gripped all nations together. So, which of these countries are rich in those kind of natural resources, and whether a country is at an advantage or disadvantage. So those are the kind of basic assessments we do. And then, of course, even when we go to shortlist the securities, so there is a very thorough risk management framework that we have at our end, where we are, shortlisting the securities. We are filtering out, we could say more than, let's say, 90% of securities actually get filtered out in the framework that we have set. So those are some of the rules. I mean, to summarize, we have both quantitative filters as well as qualitative assessments in order to shortlist the securities.
The next question, exposure to commodities and the currency is mentioned in your write-up is on available opportunities. When those opportunities will arise, can you expedite this?
So when those opportunities will arise is actually a very difficult question, because commodities and currencies, in our opinion, are very, very tactical calls, very, very short-term kind of a phenomenon. Like right now, if we look at the current scenario only. So last year we saw that commodities have had a very good run. And right now, because of the recent geopolitical turmoil, suddenly we had crude and natural gas shooting up. So, that is one set of opportunity. Even currencies. So, different central banks are actually divided in terms of the timing of their monetary policy tightening. Like US is now looking at a very, very aggressive monetary policy tightening, as suggested by some of the experts. Whereas Japan is kind of waiting it out. And this is really reflected even in the currency pair. So when do such opportunities arise is very, very difficult. In fact, one of my colleague was just discussing an analysis he did that right now, see, commodities could be up on a YTD basis while equities have corrected in 2022. But if one has to really look at a 20-year history, only a commodity invested would have given only 30% absolute return. So that's actually a very, very negligible CAGR. While a broad-based equity strategy over a longer period would have given anywhere between 4x to 5x returns. So it is very, very difficult to actually time the commodities kind of a thing. And of course, as we mentioned, one of the pillars of our process is a long-term approach. So if we have a reason to believe that the commodity exposure could give us medium to long term, or even let's say short to medium term, or simply put, if we are in a situation where we don't have to frequently churn the portfolio, so that is where we may take exposure. But otherwise, deciding how and when these opportunities really require those kind of analysis, particularly the policy action.
Traditionally, we were taught gold should be in your asset allocation when you go for investing debt, equity, and gold has been thought as three places where you should divide your money. Gold is a missing piece here. Do you have allocation to gold in your portfolio?
So, I mean, yes. So we have commodities in the multi-asset portfolio. So, there is exposure to commodities that we are considering. So we are not only looking at gold, but there is even silver, there is precious metals, there is base metals also. So, and we have those kind of instruments, listed instruments that give us exposure to gold. So yes, we are actively tracking this asset class, and whenever there is an opportunity that we think is right, is where we might as well allocate into the portfolio.
Someone gives you money today.
Yeah.
How do you plan the deployment? Someone has got deferred deployment. Someone deploys on the day one. And what is your deployment strategy? Is it staggered or it is done once?
So generally, I mean, and this is something that we've borrowed even from our domestic PMS, is generally we believe in a staggered approach because especially because our investment horizon is a very, very long-term period. So then there is absolutely no point, deploying everything on day one in a rush, because deploying everything on a day one could also mean that we are attempting to time the market, which is definitely not the intent. So yes, we are also following a very, very staggered kind of an approach. As per the recent IFSCA regulations, the minimum ticket size is 150,000 US dollars. So, once we receive those funds, then, we are staggering it over a period of, let's say, a month, 2 months also. Sometimes it could be even more. Especially, we proceed with caution in the current times that we operate in, given, let's say, the monetary tightening by the US Federal Reserve and other geopolitical events that are happening. So yes, a staggered approach is something that works best for us. And of course, the staggering is only for an operational convenience. The objective is never to time the market.
The next question is, what deployment strategy you follow and when do you make the changes? And when you want to come out or trimming the positions, how do you take these calls?
Sure. So, giving you a very bird's eye view of this. So we look at changing the constituents of a portfolio, once every year, while we monitor the portfolios actively on a daily basis. But on a quarterly basis is something where we actively review the constituents also. Generally, we may do it 6 months to 1 year is where we could do some bit of a churning. But obviously, because this is an actively managed portfolio, there is absolutely no rule-based rebalancing. So if there are particular exposures wherein our assumptions about a particular theme or a particular sector have been significantly challenged, then you may also see that we could have exited some of these themes in less than 3 months also. Obviously, the idea is not really churning the portfolio frequently, but it is about justifying the assumptions that we are operating with. But yeah, 1 year period is something where you can see is where we could be churning the portfolio. And of course, we also don't have a mandate that we have to compulsorily churn each and every security over a period of time. So over a longer period of time, if a particular theme has really played out well for us, and we have a very strong reason to believe that this can actually continue for the future, then you may actually end up seeing a theme in the portfolio for 5-6 years also. So, absolutely. So, but yeah, once a year is something on an average you can say is a reasonable churn for us.
And the next question is very interesting. Global investing beyond US, this investor thinks it is a complex one. Do you think diversifying only to US is good enough?
So, of course, I mean, US is the stronghold for the world economy, undoubtedly. But right now we are looking at US indices, which have actually been the most beaten indices, as compared to India. Of course, indices like China and Russia have done even worse. But right now, so US has been beaten down. And that is where I can actually connect, this question to a previous question that you asked me a while ago about single country exposure risk. So yes, in our portfolio, the strategy is diversifying across different regions. While some of these themes and disruptions, because they reside in the US, so the exposure will also be US focused. But otherwise, we think a prudent strategy would be some allocation to other regions as well. Okay, for diversifying overall risk and obviously to capture some of the opportunities that reside elsewhere. I mean, if I have to give you a classic example, like very recently, the entire South American belt. So, some of the ETFs in the South American belt have given phenomenal returns. And we are talking about countries like Peru, Brazil, Chile. Okay. So while global markets were correcting, but if you look at the 6-month returns of these portfolios, so they have actually done well. So an investor, okay, instead of fully diversifying in US, if he or she would have considered some allocation to other regions, then maybe the downside risk could have been much more protected. So yes, diversification is definitely important in such cases.
Of course, suddenly Indonesia does well of late.
Yeah.
And the next Indonesia
does well.
And you continue. You said something, please.
No. So I was, just continuing the point. So this is actually a point which I spoke about in the second slide, that, there are select countries which stand to gain from emerging trends. So I had discussed Kazakhstan, I discussed Chile. Okay, now today, the entire world is all about startup innovations and investing. And suddenly there are opportunities in Israel, because Israel is like the startup capital of the world. So, I mean, those are the opportunities. As I mentioned, that 60 plus countries, okay, is something that you can actually invest in using listed securities. And that too, which are trading in the US markets. So, I mean, the opportunities are plenty. It's all about, let's say, diversifying and, capturing upside wherever possible.
So absolutely, you don't touch unlisted securities, correct?
Yeah, so in this product, we are not touching unlisted securities. I mean, in the regulations, there are some provisions which do allow, they place some conditions. But in this product, we are not looking at really unlisted securities. We are looking at only listed products which have good volumes on the exchanges.
Okay. How the taxman treats this? This is a very interesting question, because sure, everyone knows 10 and 15% only. And for how the tax treatment for the gains
So yes, so this is a very, very important question, okay, from the income tax point of view. So the response at our end is that for resident Indians, the income which one is making on portfolio management services in Gift City is taxable. Like, people would have read about the tax advantages that an entity will derive in Gift City. But that is for the entity running shop in Gift City. But investors deriving investment income from Gift City is definitely taxable for resident Indians. And the taxation rate is the fixed income or the debt taxation. So the long-term capital gains will be taxed at 20%, with, of course, the benefit of indexation on cost. And the short-term capital gains will be taxed at the applicable slab rates of taxation. For a non-resident Indian, the Gift City income is exempt, but even that is subject to certain conditions, as was announced in the very most recent budget. So yes, it is taxable, and regular equity taxation will not apply. Very, very important point.
Yeah. See, you invest in different time zones, and how often the portfolio is updated for a customer to see how much he made, and can you elaborate this?
Sure. So once again, very, very important question. So right now in our portfolio, we are looking at only US listed securities. So today, if we want an exposure in Nigeria, for example, so there is a Nigeria ETF which is trading in the United States. We don't have to actually go to the Nigerian markets. So similarly, let's say if it is an Australia-based ETF, okay, which was doing decent, which was doing quite well. So we don't have to go and invest in Australian dollars. We are directly buying the Australia ETF, which is trading in the United States. So for us, the portfolio, or rather for the clients, the portfolio comprises of US listed securities. So the portfolio will get updated when the US markets close. So, all the reports that we give, the month-end reports, will be on the basis of the closing prices in the US markets. So, I mean, and that is exactly the advantage which even this gift city route is providing us, that we can directly invest in overseas markets. In fact, if I have to, if there is time, yeah, there is some time. If I have to actually add one more point, gift city, okay, specifically the IFSCA regulations specifically allow us to invest in overseas markets, but they are not limiting our investment universe only to securities in the gift city exchanges. Like all of us must be aware that there are a couple of exchanges in gift city on which you have these depository receipts of foreign companies trading. But for us, I mean, the regulations, you can actually invest in markets outside India. So directly you can go to something like a NASDAQ and NYSE American and then invest. And, that is the route that we have taken. And, that is how the portfolio holdings also get updated.
The most repeated word in your presentation is the gift city. Okay,
Yeah.
and an investor wants to know that the infrastructure in the gift city is still in the nascent stage. How easy or difficult for an investor to invest through the gift city? Can you throw some light where we are on the gift city and how it should evolve, and where this kind of examples in international examples, if you draw, where they were and where we are?
Oh, absolutely. I think that's a very, very pertinent question. I think we should really be addressing in detail, if I may add. So yes, I think the observation is absolutely right that right now the infrastructure and gift city is evolving. In fact, I operate out of gift city only. So, all my activities are based out of gift city. So when I'm in gift city, like I see only 3 or 4 buildings, but all the buildings are fully operational. Okay, that's number one. But that is about the physical infrastructure. But the infrastructure that we require for trading, okay, so be it the banking setup, or be it the fund transfer mechanism, or then let's say transferring funds from the gift city banks to our overseas brokers. So all those aspects have been very clearly set up. One of the points in my PPT was that the experience for the investors is very, very seamless. Okay, we really focus on seamless execution. So for an investor coming to Gift City, I mean, of course, not a physical presence, but opening an account in Gift City, remitting funds to the Gift City bank, and then from there having the global securities invested, and then all the post-investment procedure in terms of the reports, the audited statements. So everything has been established. I mean, if I really have to draw a parallel, so last month I was actually in Dubai for work, and there I had visited the DIFC zone, which is the Gift City equivalent. Today, if we see, the DIFC has been developed, okay, it is very, very well developed, and it is replete with all the facilities, all the infrastructure, okay, all showrooms and coffee shops also. I mean, if I have to add those things as well, where actually people come, people do meetings. So that is a very, very evolved financial services center. But when I actually speak to people who were there in, let's say, Dubai since 5, 10, 15 years, and when I actually show them pictures of Gift City, so they are like that, okay, this was exactly how DIFC was, let's say, 10 years ago. So yes, infrastructure is fast evolving, but the effect of this will be felt over the next 5 to 7 years. And if we are really tracking some of the regulatory changes and some of the announcements which are happening in the budget for the past 2 to 3 years, one can very clearly see that all the more impetus is actually being given to Gift City, okay, to develop that infrastructure. Because as I pointed out, that the whole goal of the IFSCA and the Ministry of Finance is actually to make Gift City at par with some of the best international financial services centers in other countries. So the regulations are evolving that way. The concessions are evolving that way, and all the more. Okay, so a lot of global banks. In fact, the last meeting that we had with regulators. So I mean, there are rather the last webinar that we have. Okay, so there are almost 5 to 6 international banks that have now come to Gift City. So they have committed to office spaces. Okay, there are ancillary services like consultants who have set up shops in Gift City. So consultants, their team of chartered accountants, everyone is operating out of Gift City. So definitely, I mean, with every passing year, one can see all the more impact of this. And as far as the operational seamlessness goes, so that is something which is established. We have demonstrated it for our clients. So I think investors can be rest assured that they can just go ahead with the gift city route if they are considering global investments.
Of course, the government is very committed to develop this into a world-class facility.
Absolutely,
We
absolutely.
hear from the FM statement in the budget. After that, the follow-up action on the ground you are seeing is what is a testimony to the government statement.
Yeah, absolutely.
And see, there are a lot of other questions have also come. Last two questions I'll take. Okay.
Yeah, sure.
And what is the minimum ticket size? Suppose someone has got the money. How the process happens? How many days it takes, and for them to envisaging interest for closing the whole PMS process, and you are investing. What is the process?
Yeah, so minimum ticket size is $150,000. So $150,000 US dollars is the minimum ticket size as per the recent IFSCA regulations. For the process, what we can do is, I can actually get into the technicalities now, but it will become very lengthy. So you can drop a mail to us, and we'll explain this step by step to you. But to summarize the process, it is about the investor opening an account with us, remitting funds to our gift city account, and then from then that is where we take it forward. And then, of course, because this is a PMS, so investors will be directly investing in the particular holdings. So the holding statements which the investor will get will contain all the actual holdings of the global securities. I mean, that's the process in a nutshell. But do write to us, and we will be more than happy to elaborate, the process of account opening and all the documentation and everything.
Of late, Indian government got a lot of USD that we all know. And what is this USD dollar advantage we are talking about in the portfolio, which will create an alpha of 3 to 4%, or 2 to 4 is what you told, broad range. How it works? Can you elaborate?
Sure. So when the investors are remitting funds to Gift City, okay, so they would have remitted it at a particular exchange rate, and as we said that we are investing in US listed securities. So for us, it is about receiving money in US dollars and then investing in US dollars. Now, after 5, 6, 7 years, whenever the investment objectives of the investor have been met, and he or she would like to redeem the portfolio, so that is where we remit the US dollars, as in we redeem the securities and remit the US dollars back to the account of the investor, which will obviously be converted at the existing account rate, the USD INR rate then. Now, this 2 to 3% dollar depreciation is something that we saw in the last 6 years. Of course, I mean, the next 6 years, next 10 years, obviously, we really cannot authoritatively say that it is always going to depreciate. But yes, the US dollar itself is a very stable currency. So, that is the kind of stability which the portfolio, will bring in as far as the currency risk goes. And yeah, I mean, that is the dollar advantage. So that is the dollar diversification that we are talking about, that a person has a portfolio in INR all this while in terms of Indian securities. So a fresh allocation, or let's say, reallocating some portion of the existing portfolio to a dollar exposure, which is a much more stable currency, is the advantage which the portfolio will offer.
Yeah, we have come to the last leg of our webinar today. We have got some more questions have come, but we don't have time left, and we will send across these questions so that it can be addressed by you, so we can go back to them and give the answers which was received from you in a week's time. And Mihir, thank you very much. I want to thank the participants also. The regular participants and our strategic partner, Paytm customers also have joined this webinar. I want to thank each one of them. I would like to thank you once again. Thank you.
So thank you everyone, and thank you the team of PMS Bazaar for giving us the opportunity to present our global products. Most importantly, the kind of questions were very, very pertinent, very, very relevant. So thank you all of all the participants to make this session very, very engaging. I do realize that there are a lot of other questions as well. So, I mean, you can write to us and we'll be more than happy to help.
Thank you very much.
Thank you.